This wouldn't just be another headline in a trade war. This is the activation of what some call the financial nuclear option. The consequences wouldn't be abstract numbers on a screen. They would be immediate and tangible for people everywhere. What you're about to hear is not a prediction, but an exploration of a hypothetical. It's a detailed breakdown of the potential economic shocks that could follow such an event. This isn't a question of if it will happen, but what it might look like if it did. The information here is critical for understanding the fault lines in our financial system. What if the greatest threat to your financial security came from a single keystroke in Beijing? The idea of China dumping the US dollar is a hypothetical scenario, but it's one that top analysts are forced to model, and the potential outcomes are frightening. This isn't just about tariffs, it's about the very foundation of American economic power. In this analysis, we'll walk you through the 7 shockwaves of this potential economic cataclysm, step by step. This is the story the mainstream media often avoids: the problem, the catalyst, and the retaliation. To understand the scale of this hypothetical threat, you have to understand the trigger. Imagine this. A new U.S. administration imposes a sweeping, unprecedented set of tariffs on Chinese goods. We're not talking 10% or 25%, but tariffs potentially over 60%. The stated goal is to protect American industry, but in this scenario, Beijing views it as a declaration of economic war. For decades, China has been one of the largest foreign holders of U.S. debt. As of mid-2025, Japan is the largest holder, but China remains a critical player, holding hundreds of billions in U.S. treasuries. This relationship has been a cornerstone of the global economy. China invests its trade surpluses into U.S. bonds, and the U.S. gets to finance its debt at lower interest rates. But this dependency is also a potential vulnerability. It has placed a powerful lever in the hands of an economic rival. In this high-stakes scenario, let's say Beijing decides the pain of the tariffs is too great. They conclude that the only way to truly fight back is to target the heart of American power, the dollar itself. The announcement could come without warning. A statement from the People's Bank of China about diversifying assets, citing instability. But the world would read between the lines. It's the start of a great sell-off. In this hypothetical, China begins to unload its vast holdings of U.S. Treasury bonds, not all at once, which would crash their own holdings, but steadily and relentlessly flooding the market. This is the problem: a direct, calculated assault on the U.S. economy using America's own debt as the weapon. The immediate effect is panic. Global financial markets, built on the dollar's stability, are thrown into turmoil. It's not a slow-moving crisis, it's a financial heart attack, and the real-world consequences would begin within hours. The agitation, shockwave 1, the instant market crash and confidence collapse. The first shockwave wouldn't be economic, it would be psychological. A global vote of no confidence in the United States. The moment one of the world's largest economies signals it's abandoning the dollar, financial markets could go into a freefall. Think about the opening bell on the New York Stock Exchange. The Dow could plummet by thousands of points in minutes. Circuit breakers might trip again and again, but they wouldn't stop the bleeding. Investors would be fleeing U.S. stocks, bonds, and anything priced in dollars. Why such panic? Because this move would shatter the most important pillar of modern finance. The idea that U.S. Treasury bonds are the world's risk-free asset. For 50 years, financial models, retirement plans, and corporate savings have all run on this principle. When the world needs a safe haven, it buys U.S. debt. If China starts selling, it sends a terrifying signal. The safe haven is no longer safe. This could trigger a contagion. Other major holders of U.S. debt, like Japan and the UK, would face an impossible choice. Do they hold on and watch their assets lose value? Or do they join the sell-off to cut their losses, making the crisis even worse? In our scenario, fear rules the day. Even a small sell-off from other nations would pour fuel on the fire. The message to the world would be clear: get out of the dollar now. Confidence in the U.S. evaporates. The stock market crash is just the first symptom. Trillions in household wealth tied up in retirement funds could be wiped out on paper. The panic on Wall Street would spill over to Main Street, and a deep, chilling uncertainty would grip the nation. The agitation, shockwave 2, the dollar devaluation, and the inflation bomb. The second shockwave hits your wallet. It's the sound of your purchasing power disappearing. As China hypothetically floods the market with U.S. treasuries, the law of supply and demand takes over. An oversupply of dollars means the value of each one drops hard. In extreme models, the dollar could lose 10%, 20%, or even 30% of its value against other major currencies in weeks. What does this mean for you? The cost of everything imported skyrockets. The phone you use, the car you drive, The clothes you wear, a huge portion contains foreign parts. A 20% drop in the dollar's value is like a 20% price hike on all those items. But it gets worse. The real pain comes from commodities priced in dollars, especially oil. As the dollar weakens, it takes more dollars to buy a barrel of oil. The price of gasoline could surge to levels we've never seen before. Some worst-case models project prices of $10 or even $15 per gallon. This is the inflation bomb. It's a tax on every American. Your grocery bill explodes. The cost to heat your home or run your air conditioning becomes a massive burden. While most economists believe full-blown hyperinflation is unlikely in an economy like the US, this scenario could trigger a severe inflationary spiral. Your salary stays the same, but it buys less and less. Your savings, sitting in a bank, would be silently eroded every single day. The agitation, shockwave 3, the interest rate nightmare. As the dollar's value falls and inflation explodes, the US government and the Federal Reserve are cornered. They face a huge problem. Who will buy our debt now? With a major customer selling and others getting nervous, demand for US bonds could dry up. To attract new buyers, the government would be forced to do the only thing it can: offer much higher interest rates. The US Treasury might have to offer yields of 8%, 10%, or even higher on its bonds just to find lenders. This isn't just a number on Wall Street. It's a shockwave that rewires the entire American economy. The interest rate on US Treasuries is the benchmark for all other loans. If it skyrockets, so does the cost of every other type of borrowing. Mortgages would be the first victim. Adjustable rate mortgages would reset to crippling levels. A 30-year fixed mortgage rate could surge into the high teens, making homeownership unaffordable for most. The housing market could freeze and then collapse. Car loans and credit card rates would follow, trapping millions in debt. For businesses, it's even worse. Companies rely on credit to invest and grow. When borrowing becomes too expensive, they stop hiring and expanding. A high-interest rate environment chokes off the economy's lifeblood, guaranteeing that the inflation crisis is followed by a devastating recession. Section 5, the agitation, shockwave. 4, supply chain, collapse and mass shortages. The fourth shockwave is the sight of empty store shelves. The global supply chains that keep our lives running aren't built to handle this kind of economic earthquake. The crisis would hit from 3 directions. First, the devalued dollar makes imported goods and raw materials incredibly expensive. An American company relying on a part from overseas might not be able to afford it anymore. Second, the financial chaos makes trade financing impossible. International trade relies on bank guarantees. When the currency is in freefall, those guarantees are worthless. A supplier in another country won't ship goods if they don't trust the dollars they'll be paid with. Trade could seize up. Third, in this scenario, China might impose its own export restrictions on critical materials the U.S. needs, like rare earth minerals for technology and defense. The result could be a supply chain collapse more severe than anything seen during the pandemic. We could face shortages of medicines, many of which have ingredients sourced from China. The auto and tech industries could grind to a halt. For the average person, this means empty shelves at the pharmacy and grocery store. It means the just-in-time delivery system becomes a never-in-time system of scarcity. The agitation, shockwave 5, the unemployment tsunami, and corporate graveyard. The fifth shockwave is the most personal: losing your job. The market crash, inflation, high interest rates, and broken supply chains all create a perfect storm for a corporate bloodbath. Businesses would be fighting a war on all fronts. Their borrowing costs are sky high, their supply chains are broken, and their customers have stopped spending. This is an extinction-level event for many companies. The first to go are companies reliant on global trade. Retailers and manufacturers shut down production. Layoffs begin as a flood. Then, the wave hits domestic industries. The construction sector, wrecked by the housing market collapse, lays off millions. The auto industry sheds jobs. Restaurants and bars become ghost towns. In extreme models of this scenario, unemployment doesn't just rise, it surges into double digits, rivaling the Great Depression. This creates a downward spiral. Mass layoffs lead to less spending, which leads to more business failures and more layoffs. The government, with its own finances in ruins, would have limited ability to step in with stimulus. The agitation, shockwave 6, the geopolitical humiliation, and a changing world order. The sixth shockwave is the geopolitical fallout. For over 75 years, America's global power has been tied to the US dollar's dominance. The dollar as the world's reserve currency allows the US to impose sanctions and project influence. If China were to dump the dollar, it would be a direct strike against that power. The aftermath would see a frantic realignment. The BRICS nations have already been building the architecture for a post-dollar world, creating alternative payment systems and trading in local currencies. This event would be a signal to accelerate those plans. Oil-producing nations, who have priced their oil in dollars for decades, would be forced to reconsider. They might start accepting other currencies, shattering a cornerstone of U.S. financial power. America's allies in Europe and Asia would be caught in the middle, forced to act in their own self-interest. Crippled by a domestic collapse, the United States would see its ability to project power fade. Its threats of sanctions would sound hollow in a world moving to a financial system it no longer controls. This shockwave represents the humbling of a superpower and a potential shift away from the American-led global order. The agitation, Shockwave 7, the social and political unraveling. The final shockwave turns the economic crisis into a societal one. When people lose their jobs, savings, and hope, the social fabric tears. Mass unemployment, crippling inflation, and shortages would create a level of social unrest not seen in modern American history. Protests and riots could become common. The political blame game would reach a fever pitch, leading to complete paralysis in Washington. Faith in institutions, already fragile, could shatter. The crisis would deepen every existing social division. This is the ultimate fear in such an economic attack, not just winning a trade war, but triggering a systemic collapse from within. To prove that the American model is a fragile house of cards, the empty shelves and long gas lines would just be symptoms of a much deeper crisis, a crisis of confidence, identity, and national cohesion. So we stand at the end of this hypothetical chain of events, looking into a potential economic catastrophe. From a single act of retaliation, we've traced a line to a full-blown societal crisis. This scenario is a stark warning. It's a wake-up call to the danger that emerges when economic disputes escalate. The battlefields of the 21st century might not be fought with tanks, but with currencies and bonds. The solution isn't simple, but the first step is knowledge. It's about understanding these hypothetical threats and grasping the mechanics of financial warfare. Staying informed is the only way to prepare for the shifts that could be coming. If you want to stay ahead of these kinds of stories and get information the mainstream often overlooks, make sure you subscribe to this channel and hit the notification bell. Now, I want to turn it over to you. We've laid out a potential chain of events, but what do you think? Is the global system too interconnected to withstand a shock like this, or could it adapt? Let us know your thoughts in the comments below. Thanks for watching.